Hello, everyone. My name is Madison Firstman, and I, along with my partner, Noah Martinez, are going to be presenting about our report regarding AT&T's cost of capital. At this point, I will hand it over to you, Noah.
All right, thank you, Madison. So first, we're going to kind of look at starting to look at their capital structure. So just looking at short-term debt versus long-term debt. Short-term debt means that it is debt that is going to be paid within a year. Long-term debt is any debt that will be paid in a longer period than just a year. So short-term, they had about $3,470 million of short-term debt in 2020. Whereas they had $153,775 million committed to long-term debt. Short-term debt decreased by about $8,000 million from the previous year, whereas long-term debt slightly increased by $2,000 million from the previous year. And now it's a relatively low amount of short-term debt this year compared to other ones, which is just kind of how loans work. Sometimes you have a lot of short-term debt. Other times you have very few amounts of short-term debt. So it just kind of depends. And we see these fluctuations most often happen due to the nature of loans and how debt structuring kind of works. So overall, it looks pretty standard for AT&T. There is nothing super bad here. There's nothing super good. It's good to see that they have consistent short-term versus long-term debt.
Alrighty, and now let's talk about AT&T's capital structure. Now, we calculated their capital structure and found that they source 66% of their capital through debt, and they source 34% of their capital through equity. Now, using the information from AT&T's balance sheet, we also calculated their debt to equity ratio. Notably, AT&T had a debt to equity ratio of 1.98. And that just means that for every $1 of equity, they have $1.98 of debt. That's higher than the industry average, which is $1.28. That means that AT&T's debt to equity ratio is a little riskier as compared to the industry average, and investors might find that to be less favorable. So in addition to that, we can also break down AT&T's capital structure even further and see what portion of individual items contribute to their capital structure. So for example, from the debt side of things, we can look at AT&T's long-term debt and short-term debt. So if we calculate it, we see that AT&T's long-term debt makes up 29% of their capital structure, which is to be expected. And their short-term debt makes up 0.66% of their capital structure, which is also to be expected because that includes debt that matures in no less than a year or in a year. So that's completely what we would expect to see on AT&T's balance sheet and from the calculations that we looked at.
Now, I'll talk a little bit about capital structure ratios. First one we're going to talk about is the long-term debt to long-term capital ratio. Now, we already know what long-term debt is, but long-term capital is literally just long-term debt plus stockholders' equity. So this ratio, after putting long-term debt divided by long-term debt plus stockholders' equity, we came out to a ratio of about 46.18%. So what does that mean? Well, this ratio basically measures the riskiness of a company based on its capital structuring and debt funding. So the higher this ratio is, the riskier the company is usually deemed by investors and analysts. This is just due to the issues that can arise through funding with debt and long-term debt issuances like insolvency and things like that. So having a ratio of about 46.18% is about pretty standard for most companies. So that isn't anything to be too concerned about in regards to investor relations. Next slide. And this is just another one of those capital structure ratios, common equity to total capital ratio. Now, common equity, like we kind of explored in the last slide, just means stockholders' equity in this case. And so this essentially is just the inverse ratio to the previous one we measured. So as it is the inverse, this ratio measures the kind of safeness, I guess, if you want to say, of a company. So the higher this ratio is, the safer the company is deemed to be. That is due to having a higher equity funding your capital structure is usually deemed as pretty safe because you don't have insolvency issues. You don't have to deal with repayment of loans and things like that.
Alrighty, so we also took a look at AT&T's before tax cost of debt for 10-year bonds that they were going to issue. So what we did was we took some of the information points that we had from the question and from information that we looked up, and we input these information points into one of Professor DeModderon's handy dandy worksheets. So for example, we looked at the 10-year treasury yield on T-bonds, and we found that to be 2.47%. As you can see indicated by the red arrow, that's in the spreadsheet. We also input the estimated default spread, which is 1.50%, including to other information pertaining to AT&T's financial statements. So after inputting this information, we found that the after-tax cost of debt for these particular security instruments is 3.97%.
So now I'll kind of talk about the after-tax cost of debt. So previously, we obviously talked about the before-tax cost of debt. So the first number we see is the after-tax cost of short-term debt, and the second number is the after-tax cost of long-term debt. So in regards to after-tax short-term debt, it is 3.239%, while the after-tax cost of long-term debt is 3.136%. Just a quick note, we used the statutory federal income tax rate of 21%. This is due to the federal income tax rate kind of giving you a better general estimation of the company's after-tax cost of debt. You can use the company's effective tax rate, but there are issues in case you have a year where the effective tax rate is vastly different from the previous years. So in our case, in 2020, the actual effective tax rate was like negative 33.8%, and you rarely ever see a negative tax rate. So just to make sure that we are in accordance with how the company usually performs and what tax rates they usually see, we just went ahead and used the federal tax rate, which is the safest bet. It gives you a better overall generalization of kind of the cost of debt.
So we also calculated AT&T's KS, which is the required rate of return. And we used information which includes both the ask yield on the 10-year treasury bond, AT&T's beta, and other information points to create a security market line graph. Basically, this graph shows the correlation between AT&T's returns and AT&T's beta. So as you can see, at a beta of 0.65, which is what we got from Yahoo Finance, investors require a minimum return of 7.02%. So any plots that are plotted along the security market line curve are acceptable to investors because this is the lowest acceptable return for them. Anything above the security market line is even better because that just means that they got even more return for the risk that they incurred. Anything below the security market line is not going to be acceptable to investors because they're not receiving the required rate of return that would justify them assuming the systematic risk that they would be as investors. So in this case, AT&T's required rate of return, at least for their current beta at 0.65, is 7.02%.
Now, this was kind of just an extra step we did towards the end. We just kind of wanted to visualize the weighted average cost of capital and kind of our estimation of it, what we calculated. Again, the WACC ratio is based on estimations. So people depending on what method you use, where you get your numbers from, whether your estimation of taxes are correct, and things like that. It can differ by quite a bit of a margin, but based on our estimations, what we calculated, we came up with a WACC, or a weighted average cost of capital, for AT&T in 2020 being about 5.6%. And that basically wraps up our presentation about AT&T's cost of capital and capital structure. So thank you all for watching. Thank you for your time, and we appreciate it.